And I think what we try to do is track what are people doing, where is the money going versus what are people saying versus how are people feeling about the market. Really tracking back to supply and demand. That's what we do. Price is a factor, but it's one of the last things we actually look at. And this is all based on market statistics, and we take the data from the market and we bring it to you, and we interpret it the way we have for the last 80 or so years. This is not just Apple. This is not just the technology sector. This is a broad group of stocks. One of the ways that we look at this from a stock participation basis is show me the percent of stocks in our universe that are trading within 2% of new highs, within 5% of new highs, and within 10% of new highs. You can't fool the market. You can talk about the Fed, you can talk about the balance sheet, you can talk about whatever you want, but you can't fool these numbers. So it's not just a few stocks that are carrying this market, it's a whole host of stocks. They go from large cap to small cap to micro cap. The basic bottom line here is that we continue to see evidence of a healthy bull market. Maybe not going to be as strong as last year, but certainly there's potential this is going to surprise to the upside. Bull markets, they do not die of old age. They die of weakening demand and ramping supply. So as prices move higher, people are more and more willing to sell, and they have trouble from a valuation standpoint finding new stocks to buy. In every single bull market over the last 90 years that we've studied, we've noticed the commonalities between those. So it's a process. It takes a lot of time. It takes a lot of deterioration ahead of time. So when anybody talks to me about market crash, like 87, for example, well, there was a 6-month advanced decline line divergence ahead of that. 1929, another great example. People say it was a crash. It wasn't a crash. There was a 2-year advanced decline line divergence. Right. The market will tell you if it is healthy or unhealthy. So again, look past price, look at these indicators about where the money is actually going, what the stocks are actually doing, how much participation there is, and the number of stocks that are actually going up and participating in the advance. Those are the things that really matter.
I speak really more from the gut, but that's really my training. I talk more on the sense and the tone of the markets versus specific statistics, the way that Vinny has brought out. Both sides are very important. Certainly what Vinny has to say is important, but from a kind of an investment perspective, in my role as a chief market strategist, I speak much more broadly about the sectors and not individuals.
Is there a reason why sentiment wasn't included in your slides?
Sentiment is not really something that we track because it's not about, that's just about how people are feeling. It's not what they're actually doing. That we care about what they're doing, not what they say they're doing, not what they feel like they want to do, but what they're actually doing.
That market structure has changed dramatically. A lot of the market structure has changed as a direct result of the events in 9/11, and the ripple effects of that event continue to be felt today. What it really did was it brought to light to the industry and to the nation and really to the world that here we were the largest developed market in the world, and we were still operating the largest developed market at a single location with 5,500 people looking at each other, trading pen to paper in eighths of a dollar. The rest of the world was already trading automatically using electronics and using technology. Today we have, 10 exchanges, the New York being the only physical one. The other ones are all virtual. They trade in the cloud. You can't touch them, feel them, see them, visit them because they don't exist anywhere. And then there are 40 or 50 alternative venues. It's created this very fractured and fragmented market center. And so it's more difficult to kind of read and feel the market. They used to call them tape readers, and there were guys that could stand on the floor and just read the tape because all the volume happened in one place and you got a real sense of the market. But the fracturing creates a lot more noise. Has it invalidated technical signals? I don't think it has at all. I think technicals play a real role. I think you have to understand the market structure today to better understand how to interpret some of the data, because some of the data does get blurred, right? It gets blurry because there's so much noise, but there's so much noise because of what the internet produces. Facebook, LinkedIn, Twitter, all these social networks that create additional noise, which kind of blurs the picture a little bit.
More than any year in my 4-decade career investing, that politics and profits will weigh on the markets. In terms of profits, we had the entirety of the 30% rise in the S&P last year a function of a valuation reset, higher price earnings multiples. It's incumbent upon corporate profits to rise to kind of move in and rationalize the current valuations. And in terms of politics, however it falls, it's going to have a huge implication. Policy will have a huge implication on the markets.
The name of the book is called The Age of Surveillance Capitalism. How many people have heard that phrase, surveillance capitalism?
I've read the book.
If you don't think Walmart's going there, Walmart's going there.
They're already there.
But they haven't monetized it to the same extent that Google and Facebook have. That's kind of the issue.
Okay.
You said before, it's not the FANGs, it's not just the big tech, it's across the board, and yet these companies have been, from a market cap point of view, been major drivers in the market rising higher. From a price point of view, not from an advanced decline point of view.
Right. It more has to do with, what is leadership and what is breadth, right? So, I think it's good to have leaders. It's good to know that they're healthy and what they're doing. The market's not going to go to the wayside if the FANGs, begin to underperform.
It's interesting that you say that, but the FANG stocks are clearly the ones that everyone focuses on. They're the high growth, they're the sexy names, everyone wants to be in them, they're over, they're way over-owned by everybody, right? And what we see happening is that when you get a piece of negative news, whether it's technology, whether it's U.S.-China trade, whatever it is, they immediately hit naturally the big names because they've had the biggest move. They're sexy. You can get in and you can get out, whatever. It ends up that tone, that negative tone, all of a sudden makes the bottom fall out, or feels like the bottom's going to fall out. So everything gets dragged down with it.
Yeah, maybe there's a temporary effect, but to the extent of bringing down the market for a prolonged period of time, I just it's such a broad advance at this point that I don't see it as a concern.
Well, I said the China trade deal will fall apart and that China's patience with Hong Kong will run out and there will be a global shortage of protein. I think this African swine fever virus is serious and it could cause a global shortage of protein. Terrible socially, but also a lot more inflation. I said that Tesla will trade at 600 in a speculative surge. It closed the year at 418. It hit 595 this morning and closed down 40 points from there. I think that I think you have to watch out below for the automobile industry. No one's looking there. I think sales are about to plummet, and I think it will threaten the global and domestic economies. And I think Ford will be bailed out by Volkswagen this year. And my favorite, of course, is always about Warren Buffett. I think he will buy Federal Express, another large company, consuming most of his $130 million of cash. I think that he will basically buy Pacific Gas and Electric, which out of bankruptcy. I think contrary to everyone's thinking, Apple is not a forever holding for him, and the surprise will be that he will sell a significant amount of Apple this year. He will announce his successor, Ajit Jain.
Because we're in this political environment that we're in, is that people should not necessarily get lulled into thinking that the market's not going to run into some volatility. I think it is, but in the end, I think you have to, from a long-term perspective, you got to eliminate the noise, and you got to use the pullback as any buying opportunity, because I think we're still on a growth path, and I do think that we're back to the kind of 10 to 12% return for the market this year.
No, I just think you need to keep looking at things that really matter and monitoring the health of the market, not trying to figure out why, and understand that we are still in a bull market. Whatever age you want to call it, it's still going.
And then the last thought, which is your word to remember, your homework, which is surveillance capitalism. And Doug had mentioned something about Ford. Can you believe it that Ford and surveillance capitalism are actually together? And you might say, well, what does an automobile company have to do with surveillance capitalism? Read the book, get Rana's book, and I think you'll get some insight into that. And with that, I thank all of you and ask you to please join me in thanking our panelists for an excellent discussion.